Imagine two people. Both open a checking account at the exact same bank, on the exact same day, with the exact same account type. One of them never pays a monthly fee in 3 years. The other has paid $180 in maintenance fees over that same period on an account that was advertised to them in the same branch by the same banker as completely free. Neither one did anything wrong. Neither one was misled with false information. The entire difference comes down to a single word buried in the account disclosure, the word waived, and whether a handful of small, specific conditions were met every single month without either person ever being told to check. Today, I'm going to show you exactly how banks structure free checking accounts so that the fee is always technically true and almost always avoidable, and why so many people pay it anyway without ever realizing there was a condition attached at all. Welcome to Money Autopsy. This channel exists for one reason: to translate the fine print that banks bury on page 4 of your account agreement into decisions you can actually use. Today's topic is monthly maintenance fees, the quiet, recurring charges that show up on checking and savings statements labeled things like service fee or maintenance fee, usually somewhere between $5 and $25 a month. Individually small. Multiplied across millions of accounts over years, they add up to one of the more overlooked line items in personal banking. If you find this useful, the subscribe button is right there. I put out a new breakdown like this every week. Here's the assumption almost everyone makes when they open a checking account. They assume free checking means the account simply has no fee, full stop, the way a free museum day means you don't pay to get in. That's usually not what free checking actually means in the account agreement. What it almost always means is fee waived under conditions, and the conditions are the entire product. This isn't hidden in the sense of being illegal or secret. Banks are required to disclose these terms, and they do in a document called the Account's Truth in Savings Disclosure, mandated by federal law. The information is accurate and available. It's just written the way legal disclosures are written: dense, formal, and easy to skim past during account opening when you're focused on getting a debit card and setting up direct deposit, not reading a fee schedule closely. Let me walk through how a typical monthly fee waiver actually works, because the mechanics matter more than the dollar amount. Most checking accounts with a monthly fee offer several independent paths to waive it, and you usually only need to satisfy one, not all of them. Common paths include maintaining a minimum daily balance, often somewhere between $500 and $1,500 depending on the account tier, receiving a qualifying direct deposit above a certain dollar threshold each statement cycle, often $500 or more, or making a minimum number of debit card purchases per month, sometimes as few as 5 to 10 transactions. Some accounts offer additional paths: being enrolled in a linked savings account, being under a certain age, or maintaining a combined balance across multiple accounts at the same bank. Here's where it goes wrong for perfectly responsible account holders. These conditions are evaluated fresh, every single statement cycle, independently. Meeting the minimum balance requirement for 11 months in a row means nothing if your balance dips below the threshold for even a few days during the 12th month cycle. There's no rolling average, no grace based on history, no credit for past good behavior. The bank isn't tracking whether you're generally a low-risk, well-funded customer. It's checking one specific number against one specific threshold during one specific window, and if that window shows a shortfall, the fee posts. Let me make this concrete with a story that plays out constantly in the comments section of channels like this one. A woman, we'll call Denise, opens a checking account requiring a $1,500 minimum daily balance to waive a $12 monthly fee. For 2 years, she comfortably clears that threshold and never sees a fee. Then she has a rough month. A larger than usual car repair, a slightly delayed paycheck due to a holiday shifting the deposit date, and her balance dips to $1,340 for 4 days mid-cycle. Nothing catastrophic. She's still solvent, still paying every bill on time. But her statement closes during that dip. The minimum daily balance requirement technically wasn't met for that cycle, and the $12 fee posts. Denise doesn't necessarily notice immediately, because $12 doesn't trigger the kind of alarm a $35 overdraft fee does. It just sits there in the transaction list, a small line item easy to scroll past. If the same dip happens again a few months later, not unlikely, since life produces uneven months, she's paid $24 for a total of 8 days across the year, where her balance technically dropped below a threshold she otherwise clears comfortably. Nothing about this is a mistake on the bank's part. The disclosure said minimum daily balance, evaluated per cycle, and that's exactly how it was applied. The friction is entirely about visibility. Nobody sent Denise an alert on day one of the dip saying, "You're now on pace to owe a fee this cycle," even though the bank's own systems knew that in real time. The fee is disclosed. The moment it becomes unavoidable generally isn't flagged until after the fact. You might think, okay, a $12, $15 fee here and there doesn't sound like a huge deal. How much does this actually add up to across an entire banking system? It's a genuinely significant, steady category of consumer banking revenue. And unlike overdraft fees, which faced heavy regulatory pressure and public scrutiny in recent years, monthly maintenance fees have stayed comparatively under the radar, partly because each individual fee is small enough that it rarely triggers the kind of outrage a $35 overdraft charge does. That makes it, in a strange way, a more durable revenue category. Not because it's more aggressive, but because it's less visible and less likely to generate the kind of complaint volume that leads to regulatory reform. There's a related mechanic worth understanding, because it explains why banks are comfortable offering free if you qualify accounts in the first place, rather than either charging everyone or charging no one. When you deposit money into a checking account, the bank doesn't just hold it in a vault. Under the fractional reserve banking system that underlies the U.S. banking industry, banks are generally permitted to lend out a significant portion of deposited funds to other customers. Mortgages, auto loans, business loans, while keeping only a fraction on hand to cover day-to-day withdrawals. The interest the bank earns on those loans is a major source of its revenue. This is standard, regulated, and how the banking system has functioned for a very long time. It's also the mechanism that makes a bank fundamentally different from a simple storage vault for your cash. What this means practically is that a bank genuinely benefits more from a customer who keeps a healthy balance sitting in the account, because that balance becomes lendable capital, than from a customer who keeps the account nearly empty. The fee waiver conditions aren't arbitrary hoops. They're a fairly direct proxy for, is this account holding enough value to be profitable for us in ways beyond the fee itself? Maintain a strong balance, or route your paycheck through the account, and the bank is making money from you in a way that doesn't require the maintenance fee at all, so it waives it. Keep the account thin and inactive, and the maintenance fee becomes the primary way the relationship is profitable, so it's charged. It's worth being precise here, since this is a topic that invites oversimplified explanations. Reserve requirements and exact lending mechanics are more complex than a single paragraph can capture, and they've shifted over time. For example, the Federal Reserve reduced reserve requirements for many banks to 0% in 2020, changing some of the technical mechanics involved. The core relevant point for your checking account isn't a precise reserve ratio. It's simpler than that. Your balance and activity level are genuinely valuable to the bank in ways separate from any fee. And the waiver conditions are designed around that value, not designed to be arbitrarily difficult. So here's the fix, and it takes about 5 minutes with a document you already have access to. Find your account's specific fee waiver conditions, usually in the Truth in Savings disclosure, sometimes summarized more readably on the bank's website under your account types page, or by asking a banker directly for the exact requirements to waive my monthly fee. Write down every path that applies to your account, not just the one you think you're using, since many accounts offer 2 or 3 independent options, and the easiest one for your situation might not be the one your balance style naturally satisfies. Once you know the specific requirement, set up a low balance alert, a meaningful amount above the threshold. Not exactly at it. If your minimum is $1,500, alert yourself at $1,700 or $800, giving yourself buffer room before a normal month's fluctuation risks crossing the line. If your waiver path is based on direct deposit rather than balance, confirm the exact dollar threshold and frequency required, since some accounts require the deposit to post within the statement cycle dates specifically, which can shift if your payroll schedule doesn't align cleanly with your statement cycle. If you've reviewed the conditions and you're consistently missing them despite trying, or the required minimum balance is genuinely more than makes sense for your situation, the more durable fix isn't monitoring more closely, it's switching to a different account entirely. Many banks, especially online-first banks and credit unions, offer checking accounts with no monthly fee and no waiver conditions at all, sometimes with fewer physical branch services in exchange. If you're not using branch banking heavily, that trade is often a straightforward win. There's a related trap worth a direct warning, and it involves accounts you've stopped actively using rather than ones you're actively managing: dormancy and inactivity fees. Some banks charge a separate fee, distinct from the standard maintenance fee, if an account shows no customer-initiated transactions for an extended period, often 6 months to a year, sometimes triggering an additional flat fee on top of any existing maintenance charge. This catches people specifically on secondary accounts: an old checking account kept open after a move, a savings account nobody's touched since a specific savings goal was completed. If you have an account you're not actively using, either close it formally or set up a small recurring automatic transaction, even a trivial one, to keep it classified as active under your specific bank's policy. Maintenance and dormancy fees aren't the only recurring charges worth a quick anatomy lesson, because a handful of others follow the same basic pattern: technically disclosed, easy to avoid once you know the specific condition, and easy to accumulate if you don't. Paper statement fees, often $2 to $5 a month, apply to accounts that haven't opted into electronic statements. This one has the simplest fix of any fee on this list. A single toggle in your account settings, usually labeled Statement Delivery Preference, switches you to digital and eliminates the charge immediately and permanently. Out-of-network ATM fees work differently, since they're not a monthly recurring charge, but a per-transaction one. And they're worth mentioning because they often come as two separate charges stacked together: a fee from the ATM's owner and a separate, additional fee from your own bank for using a machine outside its network. Your bank's mobile app almost always includes an in-network ATM locator, and using it before you're already standing at an unfamiliar machine avoids both charges at once. Wire transfer fees, both incoming and outgoing, tend to be flat and disclosed, but rarely questioned, often $15 to $30 per outgoing wire. For anything that doesn't require same-day settlement, a standard ACH transfer accomplishes the same movement of funds, usually for free, just with a 1 to 3 business day delay instead of same-day finality, worth checking before defaulting to a wire out of habit. Foreign transaction fees, typically around 1% to 3% of the purchase amount, apply to card purchases processed in a foreign currency, and catch people specifically while traveling internationally. A growing number of checking and credit card products are specifically marketed as having no foreign transaction fee. If you travel even occasionally, checking whether your primary card carries this fee before a trip, rather than discovering it on the statement afterward, is worth the 5 minutes. If you've already been charged a fee and want it reversed, the exact wording of the request matters more than most people expect. Calling and vaguely asking, "Can you waive this fee?" gives the representative room to say a simple no. A more effective version names your history directly. "I've had this account for a while. I've met the waiver requirements consistently, and I noticed a maintenance fee on this statement. Can you reverse it as a one-time courtesy?" This does 2 things at once. It signals you understand the account isn't broken, just an isolated miss, which makes a courtesy reversal an easy, low-friction yes for the representative. And it implicitly signals you know how the fee structure works, which representatives are generally more responsive to than a customer who seems unaware the fee was avoidable in the first place. A few quick answers to the questions that come up constantly around this topic. If I qualify for a waiver most months but miss it occasionally, Will the bank refund a one-off fee if I call? Often, yes, especially for a customer with an otherwise strong history at the bank. Many banks will waive an isolated fee as a courtesy on request, though this isn't a guaranteed right and depends on the specific bank's policy and your account history. It costs nothing to ask, and it's a genuinely common and reasonable request. Do all banks structure fee waivers the same way? No. The specific dollar thresholds, the number of available waiver paths, and even whether a waiver option exists at all vary significantly by bank and by specific account tier within the same bank. Comparing to free checking, accounts at different banks without reading each one's specific truth in savings disclosure is comparing two things that may work completely differently under the surface. Is a monthly maintenance fee the same thing as an overdraft fee? No, they're separate categories entirely, disclosed and calculated differently, and one doesn't cause the other, though a maintenance fee posting unexpectedly can, in some cases, be the exact event that pushes a thin balance into overdraft territory, connecting the two mechanics in an indirect way worth being aware of if you're managing a tight budget. Can switching to a completely fee-free account ever come with a hidden downside? Occasionally. Some no-fee accounts offer more limited customer service access, fewer physical branches, lower or no interest on balances, or restrictions on certain transaction types compared to a traditional account. It's rarely a meaningful downside for someone using mostly digital banking, but it's worth a quick comparison of the specific account features, not just the fee line, before switching. Does a bank have to notify me before charging a monthly maintenance fee? Generally, no separate advance notice is required for a fee that's already disclosed in your account agreement and simply gets applied when the waiver condition isn't met that cycle. The disclosure itself is considered the notice, even though it was given once, at account opening, rather than freshly each time. This is part of why the fee catches people off guard. The legal notice requirement and a practical, timely heads-up are two very different things. If I'm a student or under a certain age, are the rules different? Often, yes. Many banks offer dedicated student or youth checking accounts with no monthly fee and no balance requirement at all, sometimes automatically converting to a standard account with standard fee conditions once the account holder passes a certain age, commonly in their early 20s. If you opened an account as a student, it's worth checking whether that conversion has already happened or is coming up, since the fee-free terms you remember from account opening may not still apply. 5 things to take away. 1. Free checking almost always means fee waived under specific conditions. Not no fee ever. The conditions are disclosed, but easy to overlook during account opening. 2. Waiver conditions like minimum balance are evaluated fresh every statement cycle, with no credit for a long history of otherwise meeting them. A single short dip can trigger the fee regardless of your track record. 3. Find your account's exact waiver requirements in the Truth in Savings disclosure and set alerts meaningfully above the threshold rather than right at it to build in a buffer against normal fluctuation. 4. If you consistently can't meet the conditions, the fix isn't more vigilance. It's switching to an account genuinely designed with no waiver conditions at all, which many banks and credit unions offer. 5. Watch for separate dormancy or inactivity fees on any account you've stopped actively using, since these operate independently from standard maintenance fees and can quietly accumulate on accounts you've mentally already written off. Here's the exercise. Log into your bank account today and pull up your account's specific fee schedule or Truth in Savings disclosure. Most banks have this searchable directly from your account settings or via a quick call. Confirm exactly which condition you're relying on to waive your fee, and set one alert above that threshold. If you've been charged a fee in the last year without fully understanding why, call and ask for a courtesy waiver. It's a normal, common request that costs you nothing to make. If this saved you a fee, or explained one that already happened, the subscribe button does more for this channel than any single view. I break down one piece of the system like this every week. How the number gets calculated, why it moves the way it does, and what you're actually supposed to do about it. That's it for this one. This has been Money Autopsy. I'll see you in the next breakdown.